please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Very good morning. Welcome to Chartbusters. Well, this is the show where we highlight all the buzzing stocks of the day. We'll also give you some expert advice on how you can capitalize and trade. As we speak, it's a Monday morning. The Nifty is as flat as can be. But just taking a look at the Asian markets that have opened up today, well, we're doing a relative outperformance. Hey, Mangalam. Morning.
Absolutely, Nigel. You know, as we speak, the Asian markets are at the low point of the day. We will watch out for how Hang Seng as well as Taiwan play out in tomorrow's trading session along with Shanghai. But just watch out for a couple of stocks. The oil marketing companies, remember the crude oil decline has helped their cause. So HPCL, IOC, BPCL, all of them sitting at the high point of the day, taking the BSE oil and gas index itself towards the high point of the day. The mid caps underperforming with a cut of almost a 0.25%. Let's see how that trade pans out as well. But first up, all the top stories that we're tracking at this point in time. In a CNBC TV18 exclusive, First Global's Shankar Sharma continues to be very optimistic on small caps, says market was due for a correction but not due for a bear market.
And US court issues temporary restraining order against Dr. Reddy selling Suboxone generic. The stock recovers from lows as the court ruling does not prohibit commercial manufacturing of the product.
Ahead of the OPEC meet in Vienna this week, Brent slips to $73 per barrel for the first time since 3rd May 2018. Oil marketing companies are among the top Nifty gainers today.
And Adani Green lists on the exchanges today post the demerger at a price of around 30 rupees per share. The expected range, remember, was around 25 to around 30 rupees. All right, Nifty is holding as flat as can be, but there are a couple of stocks that are moving around. Sintex Industries, suddenly that stock has moved to the low point of the day. So keep your eye out on that one. And really risk off is playing out on these metal stocks. Remember in Friday's trading session itself, we did have JSPL that was down nearly around 3.5–4% odd. Today as well, JSPL is down nearly around another 3.5% odd. So keep an eye out on that front. Remember, Anshu Sharma did speak to Mr. Naveen Jindal. He's talking about a possible demerger in the works in the time to come. That could be on the table. But that stock clearly, as we speak, it's lost roughly around 7 to around 8% of its market capitalization in the last couple of days. But Nifty moves into the green. So how do you trade the Nifty? Prakash Gaba is with us in the studio. Hey, Prakash, good morning. What's the trade on the Nifty? Would you be looking to buy into the Nifty from these levels, or do you believe some downside is on the cards today?
Morning. I don't feel very comfortable with Nifty unless I would say that Nifty decides to and trades about the 8,020 mark. If that happens, then everything is okay. But if it trades below 820, these are make or break levels, then we may see downside in the days to come. Because Bank Nifty is weak. If Nifty has to go up, then Bank Nifty needs to support. So far, looks like Bank Nifty has been structurally weak, and we can see a slide to maybe around 26,300 zones. Is still a possibility. Because if it does go up, Bank Nifty has a stiff resistance in the regions of 26,500. So I'm slightly cautious here. It needs to come out of this range, show us a trend for us to buy or sell.
All right, cautious on the Nifty. Bank as well as believes that Nifty right now at 820 is at a crucial level. So we'll watch out for that. Prakash, individual stocks, what are your recommendations?
Two stocks I like, and both on the shorting side. I like ACC on the short side, looks weak, and maybe we'll see a slide to around 1280 zones. Stop about 1305 on ACC should be fine. Second is among the metal spec, National Aluminium looks weak. We can see a slide to around 66 zones. Stop about 69.
All right, Prakash, thanks a lot for that. With that, we will slip into a short break. Come back, we get chatting with the management of ENIL. That stock is on our radar as they commence their broadcast from the Srinagar radio station. We'll get chatting with Prashant Pandey, the MD CEO of ENIL. Stay with us. Welcome back. Just keep an eye out on a couple of the mid-caps which have slipped to the low point of the day. Torrent Power from the broader markets has actually accelerated its decline and currently sitting at the low point of today's trading session. Along with that, we have Havells as well, which is at the low point, and Hexaware. In fact, mid-cap IT along with large-cap IT not doing too well in today's trading session. Watch out for Tech Mahindra as well. Remember that stock has been an outperformer in the large-cap IT space, and that one currently is trading with a cut and currently is one of the biggest losers on the Nifty at the low point of the day. But the stock on our radar is Entertainment Network India, the company that runs and operates Radio City, the radio channel, that rather Radio Mirchi, the radio channel as we know. They commenced their broadcast from Srinagar radio station. To discuss this and more, we have Prashant Pandey, the MD and CEO of the company, joining in. Thanks a lot, Prashant, for joining in. First up, if you could tell us how many channels do you totally have with this launch? How many have you launched in the last 1 year? And how many impending launches, when do they come on stream?
Well, actually, we have now launched Srinagar, which was the last of the Patch 1 stations. And with that, we now have 52 operating stations. In the last year and a half, we have launched the 17 stations that we had acquired in our Patch 1. And we have 21 stations of our Patch 2, which are pending launch. They are waiting basically for the government to release the COPA, and then we can get going. I think we will be able to launch these 21 in the next 6 months.
All right, next 6 months you'll be able to launch 21 channels. How much does it cost for you to launch one channel typically?
Well, the capex, which is the setup cost of the transmitting and the operating side, typically tends to be in the region of rupees 2 to 3 crore as a one-time capex cost. And then there is, of course, the amortization and depreciation that happens. So those are other costs that are involved.
So when exactly do these, these stations break even then?
Well, our attempt has been to break even in 6 quarters. That's what we have consistently maintained. And actually, as of today, on all the phase 3 stations leaving Srinagar out, we have broken even in about 5 quarters.
So all the 16 you have broken even already?
Yes.
All right, perfect, Prashant. So with this new channel coming in, how much does your ad inventory increase by? What kind of ad inventory are you sitting on right now?
And, well, typically, sorry, go ahead.
Basically what we wanted to know is the realizations. So what happens to the realizations?
Well, typically, our approach has been very simple. In all of our new stations, we have decided not to exceed the 10 minutes of advertising volume per hour. And we've maintained that with all the 16 phase 3 stations which are already up and about, and we will maintain that with Srinagar as well. We also have another philosophy that we adhere to, which is that whenever we enter a market where there are incumbents already operating, we do not disrupt the market. We typically come in at the pricing which is equal to or higher than the incumbents, and that actually helps to build the market rather than undercut the market. So we will do the same thing in Srinagar.
So that's 10 minutes per hour on all the 17 channels that you've launched, right?
That's right.
And
yes.
the others, what kind of inventory do you have?
Well, on the other stations, which is the legacy 35 stations, because of historical reasons, the inventory has been higher. However, if you remember, last year we took a 15% voluntary volume cut, and that has brought us to an average of about 13 minutes per hour, which is where we want to be. We do not want to expand beyond that.
So last year there was a 15% cut in volumes. This year, what's it looking like?
So this year we will not be cutting volume. In fact, there are months and days where we have inventory available. So we will probably be adding the volumes in those days, in those weekends and those kind of day parts. But overall, I expect that the inventory will remain 13 minutes per hour, or maybe be at about 13 and a half minutes per hour during FY19.
All right, Prashant. So I just did the maths that you spoke about, 35 stations having 13 minutes and the remaining 17 stations having about 10 minutes per hour. That comes up to around 33,500 hours worth of ad inventory. How much do you plan to sell in FY19, and what are the realizations that you get per slot?
Well, I did not do the maths that way, but since you have done that, I will go with that number.
Okay.
Let me put it differently. In our 35 stations that we operate, we try and operate at anywhere between 85 and 100% of the full volume available. And in the new stations, we would like to operate at 85 to 100%. But however, it takes a little time for the market to develop. And generally speaking, currently in FY18, our volumes in the 16 new stations was only of the order of about 30 to 35%, which means that we can triple our revenues in the new stations.
Okay, so top line focus is what we have done so far. What about margins? What's the profitability there?
The focus in FY18 was consistently on margins, with the result that our phase 3 stations have now broken even, and rather than being a drag on the network, they have actually started contributing to the EBITDA levels. Our entire non-radio business, which is 25% of our revenues, has turned in a very good performance in FY18. We have increased our margins from ballpark 21% to about 26-27%. So we have again improved margins over there. And the core 35 station continues to maintain healthy EBITDA margins of upwards of 40%.
All right, Prashant, thanks a lot for all those details. But just before we let you go, a larger question from the industry itself, how are you keeping radios relevant given the increasing popularity of all these online apps, the likes of iTunes, you have Sawan, Ghana, all of them, and then podcasts as well. So this is a question that we posed to Radio City earlier as well. Radio Mirchi being the industry leader, I would like to know your views on that.
Well, let me tell you this thing, that this is a question that is asked all the time.
Right.
And let me tell you, I'm sitting more confident today than I've ever been in my life. And I'll tell you why. The simple reason is that if you look at the car driving audiences, and this is the creme de la creme operating in the top 20 cities, 25 cities of this country, the radio listenership is the only medium that happens inside the cars. And I challenge every single person in the corporate sector in Mumbai. They spend more time listening to radio in their car than they spend watching television on a daily basis. So radio is sitting very, very comfortable. But in addition to that, all our talent is also being used to produce a lot of video content now.
Prashant, you're sounding confident. You're saying majority of the people are listening to radio. Mangalam, you're listening to radio?
I don't listen to the radio actually, and that is exactly why I posed this question to Prashant, because I listen to a lot of iTunes.
No, but Prashant, I'm with you. I listen to the radio.
Okay.
Well, let me put it like this. Let me just clarify. If you're driving in the car, there is no way that you're not listening to radio. I drive a car.
Prashant, I drive 2 hours a day, and I listen to a lot of podcasts as well as music online. So,
but Prashant, I'm with you. Don't worry. I'm listening into the radio stations. Maybe so we're split. We're split down the middle.
So we will watch out for how this trend
Prashant
pans
the benefit
out.
of the doubt, and
definitely.
He's sounding confident as well. Thanks so much, Prashant, for speaking to us today. Looking forward to speaking to you more often this year, and importantly, we're looking forward to those numbers.
We're absolutely looking forward to those numbers. So with that, we'll take a short break. Come back. We'll get you an excerpt from our mega exclusive conversation with Shankar Sharma of First Global on the other side. Stay tuned. Welcome back. Well, the mid-cap index is down about 0.25%. Just keep an eye out on individual logistics stocks. TCI Express, low volume, so that stock has surged about 5% at the high point of the day. We also have VRL Logistics as well as Mahindra Logistics. Both of them are buzzing around, sitting closer to the higher end of today's trading range. So we will watch out for all these stocks, what exactly happens, or is there any news flow with regards to the logistics sector. As of now, we're just seeing these stocks abuzz. But let's move on. We have the big CNBC TV18 exclusive in an exclusive conversation with Anuj Singhal. Shankar Sharma of First Global talks about the bull market correction and the key risks that remain for the Indian market. Here's an excerpt.
I'm telling you that I see so many companies, so many really cheap. People say it's expensive, and they pick 5 stocks and it's expensive. And I find so many good stocks with great visibility, trading 5, 6, 8, 10, 12 times earnings. Growth is strong, or it's visible, there's no leverage. And that's where I'm hunting. And there's plenty of fish in the pond, without any doubt. So I'm very, very optimistic on small caps.
Okay.
Irrespective of macro.
Exactly. That is what I was coming to, because once again, going back to 2017, there's a lot of talk that what you had was a cost of capital rally, and now that of course is going up.
Sure.
We've had RBI also raise rates in the last policy. So is that going to be a bit of a risk then?
Yeah, it is a risk. I mean, let's be honest about it, clear about it. And I've called out on oil several times in the last couple of years from 2016 that when it was in the high 20s or the low 30s that you're beginning a oil bull market. And I still believe we are in an oil bull market. That continues to be a genuine risk for India. We all know it, and I always said India trades between 2 liquids. One is oil, one is water. Water being the monsoons. So our economic fortunes are on one side it's oil, the other side it's just the monsoons. We'll see how the monsoons go, but oil is problematic. But that said, which is why again come back to small caps, that they are not correlated with the macros. So if you're troubled with the macros, I am, and nobody sensible would not be, because you have a widening current account deficit, you have a widening fiscal deficit, or if you contain the fiscal deficit, then you have a problem on growth. And then of course you have a rate cycle which is now turned for the worse. Growth isn't great, it is tepid. So all things put together, the macro is problematic. But therefore I still need to have a view or find investments, and that's why the small caps offer a very good place, because they have nothing to do with oil prices or RBI's policies or even the politics of the country. But the large caps will be not bad, but don't expect blowout things from this stock market 1 year out.
Okay, so Shankar, in the small and mid caps, what are the broad themes that you're working with? You made a killing in specialty chemicals, for example, about 2 or 3 years back because of the China factor. A couple of infrastructure stocks, you have made huge money. What are the broad themes that you are now backing right now?
Well, like I said, broadly and again, out of luck, I think, more than competence. We just found that a lot of industries had a lot of surplus capacity, which they built during the boom years of 2004 onwards. And then because the capacities are fueled with debt, and then there was a downtrend in the overall commodity cycle, which started around 2010 until 2016, they all basically hurt, and many of them went out of business. So steel is a good case in point. Or on the other hand, you have infrastructure, where there were a lot of players bidding for a contract. Suddenly that whole thing shrank to 5, 6, 7 players. Optical fiber cables is a good industry. That was an industry, the traditional overcapacity, oversupply industry for the last 25 years, because there were like 25, 30 players. Now, because of that problem, many players exited. They shut down. Now you're left with basically a handful of players, and just 5 or 6 players, while the scale of the opportunity is massive. So steel is again, similar. So in a lot of industries, we found that because of the excesses of the boom era, they were over-leveraged, they went bust or exited, and then market shrank in terms of number of players, but the opportunities still remain quite sizable. So steel, infra, chemicals, all these spaces have looked very good. Cables.
Yeah. This optical fiber is interesting. We, of course, have one large player who has done well in terms of stocks. On the others, are there concerns about balance sheet or management or any other concerns over there?
Well, I own one of them. There are no concerns as far as because the balance sheet is very, very good. The company has no leverage. They've repaid debt.
Yeah.
And like I said, every company goes through some problems. Which company has had no problems?
Yeah.
Okay, across the world. It's how a management deals with those problems that, in my book, is what determines good or bad management, right? So this company has done well. They've cleaned up their act. They've got their act together. The numbers speak for themselves, and I think the industry looks very, very good.
Remember, you can catch this whole conversation tonight at 8:30 p.m. only on CNBC TV18. Meanwhile, keep an eye out on a couple of stocks from the markets. ICICI Bank has moved to the high point of the day. There were reports of an impending leadership change and some names were doing rounds, so watch out for that stock, up 3%. Along with that, we have the auto stocks that have hit the high point of the day, so the BSE Auto Index, which should come up for you, which is at the high point of the day. But talking about frontliners, one stock on our radar is TCS. The board approved a 16,000 crore rupee buyback on Friday. But what does this mean for retail shareholders? Well, Nigel is here with those details. Nigel.
Well, let's run you through the basic details first. The total buyback quantum that they're looking to spend is around 16,000 crore rupees. The price as well is at around 2,100 rupees on a per share basis. But basically for retail audience, what does this mean? 16,000 crores is the total amount. 15% of that, as per SEBI's mandate, is reserved for retail small shareholders. Who qualifies under this? If you're holding shares worth 2 lakh or less, then you'll come under this particular category. So basically 2,400 crores is the amount that's been reserved for retail shareholders. That's the number of, those shareholders that have holdings worth sub 2 lakh rupees odd. Now, investors holding around 108 shares. How do I get this number? If you buy shares as of now, that is at around 1,840 rupees, 108, then you would qualify to come under this 2 lakh bracket odd. But there are a few costs. Everyone's talking about what is the profit. I want to alert our viewers there are a few costs. One is your transaction cost. That's basically your brokerage. It'll be roughly around 1,000 rupees to around 1,500 rupees. So that is one cost that you need to note. The second cost is, if you're going to be blocking 2 lakh rupees, it should get blocked for at least 3 to around 3.5 months approximately. And you'll assume that suppose you borrow that particular money. If you borrow it at 8%, 10% and 12%, we have given you 3 scenarios out there. So if you're borrowing this money for a period of around 3 months, then you have an opportunity cost or you actually have a borrowing cost that you have to incur. So one is the transaction cost. Second is the borrowing cost. And third as well, there'll be another cost that will come in there. That's the taxation aspect then. Assuming you make 27,000 rupees, then in fact you have to pay short-term capital gains of around 4,000 rupees. Assume you make around 16,000 rupees, then it will be at around 2,400 rupees. So stacking up all the cost, everyone's looking at the profits. Remember, if you're looking to buy this buyback just, to make some money, you stack up the cost. Let's get that up for you on the screen. There'll be a brokerage cost of around 1,000 rupees. You'll have the time value of money, effectively around 4,000 to around 5,000 rupees, depending on the cost, depending on the period as well. And there'll be a short-term capital gain as well of around 3,200 rupees. Very important, retail audience, remember, if you just got shares in the bonus, be very, very careful because the acquisition cost out there is nothing. So you're basically going to pay, and if you're tendering those shares in, then you'll be paying that 15% on the entire amount. So 315 rupees will be the effective tax because your cost of acquisition is absolutely nothing. Back to you.
All right, Nigel, thanks a lot for that. Important details out for our retail shareholders. With that, it's time out on this edition of Chartbusters. Stay tuned to CNBC TV18.